Hello, this is my learning summary video on my first week on corporate finance class at IPMI International Business School. Today we will talk about 10 principles of financial management, something that commonly believed and often used as a base for decision making. From those 10 principles of financial management, there are several particular points that I think tends to be overlooked, so we need to revisit it. First, cash is the king. In many cases, people tend to overemphasize on income statement and skipping the cash flow statement. This is a classic error when we are evaluating a company, because it is possible that a business could generate a lot of cash flow while its comprehensive income recording at a loss, or a comprehensive income recording a profit, but its cash flow actually negative. The point being is there are accounting effects in income statement that if we did not evaluate the cash flow, it could be misleading. If a company has a lot of cash flow, it could easily finance something unless necessary to use that. Second point is about incremental cash flow. Incremental cash flow can only be a good way to assess whether to invest in a new project or to buy asset, although it shouldn't be used as the only measurement. But the thing is, the availability of positive incremental cash flow is a good sign that the project or asset is bringing more profit than it brings expenses that will incur. This is still related to the previous cash is the king point. And the third principle is the curse of competitive market. It means where some things are easy to make profit, there are always a significant increase in supply because competitors trying to follow through. Therefore, it will make the supply curve is unbalanced, that excess supply will push selling price and profit down because the demand were not catching up. The point that we have to be critical, that marketing approach can be a one-fits-all solution. True, good marketing may push the competitors away, but since marketing is costly and we tend to do it without think properly about it, we should be critical that in the end only one or two players can rise on the top and overcome the curse of competitive market. So in a competitive market, always think first, don't just being a follower and make a decision based on impulsiveness. And the last point is tax bias decision. Tax usually is so influential that a company tends to be biased because making a decision based on reducing taxes rather than making a decision based on a clear economic rationale usually occurs a lot in a family management. Indeed, using a debt to finance our expansion could provide us a tax shield to justify our approach to take on more risk. But since there are two things being certain in life, which are death and tax, we should be careful not to overdo our business decision based on reducing taxes, because making ourselves biased about it will be backfire later on. That's it for this week. Thank you.